America's housing crisis has taken a new, terrifying turn, one that even the experts didn't see coming. It's not just high mortgage rates, it's not inflation, it's something far more dangerous: insurance. In 2025, the cost to insure a home has exploded to record levels. Policies that once cost $1,500 now exceed $7,000, if you can even get coverage at all. From California to Florida, insurance companies are pulling out of entire regions, leaving homeowners stranded and potential buyers walking away. The result? Thousands of properties sitting empty, for sale signs gathering dust, markets frozen by fear. In some cities, homes aren't just overpriced, they're unsellable. Welcome to Discover the Nation, and today we're counting down the 10 U.S. cities where insurance is destroying the housing market, turning once booming neighborhoods into ticking financial time bombs. Stay with us till the end, because number one isn't just a city, it's a warning for the entire country. And before we dive in, make sure to subscribe, because every week we reveal the real stories behind America's housing and economic collapse.
Number 10. Baton Rouge, Louisiana. In Baton Rouge, home insurance has become an extinction event. Once considered a safe haven from the Gulf Coast's worst storms, Baton Rouge is now drowning under premiums that have more than tripled since 2020. A modest $250,000 home now costs over $5,800 a year to insure, if you're lucky enough to find a carrier. Major insurers like State Farm and Allstate have stopped writing new policies altogether, citing record storm losses and mounting reinsurance costs that make Louisiana one of the most volatile markets in America. For sellers, that means buyers walk away before even touring. Real estate agents call it deal death at underwriting. Every potential sale now starts with one question: can the buyer even get insured? Inventory has surged 42% year over year, and homes are lingering on the market for months. Even price cuts don't help, because buyers can't absorb the carrying costs. Some sellers are dropping prices by $50,000 and still seeing no offers. What's worse, Louisiana's state-run insurer of last resort, Citizens, has increased rates by another 63%, leaving thousands of homeowners stuck paying what feels like 2 mortgages just to stay covered. Many are giving up and moving out altogether, turning entire neighborhoods into ghost streets of for sale signs. The crisis has gone beyond affordability. It's psychological. Buyers fear owning anything in a market where a single storm can erase years of savings overnight. Baton Rouge isn't just facing a slowdown, it's facing paralysis.
Number 9. Palm Springs, California. It's not hurricanes that threaten Palm Springs, it's wildfires. Once a paradise for retirees and luxury buyers, Palm Springs is now on the front lines of California's insurance retreat. Insurers have dropped over 250,000 homeowners statewide, and Palm Springs is among the hardest hit. Many can't even renew coverage at any price, and those who can are paying 5 times what they did just a few years ago. A home that cost $1,800 a year to insure in 2019 now costs over $9,000 annually under California's FAIR Plan, the last resort policy that offers minimal protection and zero peace of mind. It doesn't cover everything, and it often forces homeowners to buy expensive supplemental fire coverage just to meet lender requirements. Buyers are backing out, lenders are hesitating, and cash deals are drying up. Agents say half of all escrows now fail due to insurance delays. Luxury listings that once sold in weeks are sitting 200 to 300 days on the market. Even million-dollar homes are being relisted again and again with no offers, while sellers slash prices hoping to spark interest. And it's not just homeowners. Small businesses and rental investors are feeling the heat too, with commercial insurance premiums rising up to 400% in fire-prone areas. Local builders warn that new construction will slow to a crawl because insurance has made profitability impossible. Palm Springs, once a symbol of effortless desert living, now feels like a market on fire in every sense of the word.
Number 8. Charleston, South Carolina. Charleston's charm comes with a cost, and that cost is skyrocketing. This historic coastal city has seen insurance premiums jump 60% in a single year, driven by flood risks, stronger hurricanes, and the growing cost of coastal maintenance. Many insurers now require $10,000 deductibles for storm coverage, meaning even small claims are devastating. Homes in the city's treasured districts that once fetched $800,000 to $1 million are now sitting unsold for months, forcing sellers to slash prices. Real estate agents say every conversation begins with two words: flood zone. New FEMA flood maps have been redrawn, placing thousands of previously safe properties into high-risk zones overnight, instantly inflating insurance requirements and tanking affordability. Local agents say half of pending sales collapsed during the insurance quote phase, as buyers discovered their premiums could exceed $7,000 or more annually. And with more tropical systems forming every summer, the fear factor is driving away investors. Builders are halting projects near the waterfront, and some condo associations are warning residents of 50% HOA fee hikes to cover insurance hikes. Charleston's beauty hasn't faded, but its accessibility has. For middle-class families, the dream of southern coastal living is being priced and insured out of reach. Even lifelong residents are leaving, unable to carry the burden. Charleston's housing market isn't just slowing, it's sinking under the weight of risk.
Number 7. San Diego, California. For decades, San Diego was seen as the safe California bet. High prices, low natural disaster risk, and a lifestyle that felt untouchable. But not anymore. Rising wildfire exposure across Southern California has insurers treating even inland neighborhoods as red zones. Entire zip codes once considered stable are now classified as elevated risk areas. In 2025, the average home insurance premium in San Diego County has climbed past $5,500, a 110% increase since 2020. That's before factoring earthquake riders and supplemental coverage. Some homeowners report total annual costs exceeding $9,000. Worse, insurer exits and new regulations have created a logjam in approvals. Some buyers wait up to 2 months just to receive a quote, derailing closings and sending deals into limbo. Real estate transactions in the region are down 30% year over year, while luxury markets like La Jolla, Del Mar, and Encinitas are seeing multi-million-dollar listings stagnate. Cash buyers are rare, and even they hesitate because resale prospects look bleak. Lenders, too, are tightening standards, demanding proof of comprehensive coverage before funding, a requirement many sellers can no longer meet. For longtime residents, the psychological toll is mounting. The city that once offered peace of mind now feels like a risk portfolio. San Diego's problem isn't price, it's perception. Buyers don't just fear losing money, they fear losing everything, and that's a far harder thing to fix.
Number 6. Tampa, Florida. Florida's insurance crisis is rewriting its housing story, and Tampa is at ground zero. Once a magnet for retirees, snowbirds, and investors chasing sunshine profits, Tampa's real estate machine has slammed into a wall built entirely by the insurance industry. Premiums that averaged $2,400 a year before the pandemic now exceed $8,000, and that's for modest inland homes nowhere near the water. Along Bayshore and Davis Islands, quotes are soaring beyond $20,000 annually, forcing even affluent buyers to step back. Since 2022, 8 major insurers have gone bankrupt, and others have quietly exited the state. Lenders now demand verified coverage before closing, a step that kills deals before they ever reach the appraisal. Realtors call it the new contingency of fear. Inventory has surged 70% year over year, pending sales are down sharply, and nearly every MLS page is littered with price cuts.
Some sellers slash $100,000 just to compete and still can't move their listings. For middle-class homeowners, the math no longer works. Many now pay more in insurance than in mortgage payments, draining retirement accounts just to stay covered. Tampa's story was once about expansion, cranes, condos, and cash buyers from Chicago and New York. Now it's about contraction, frozen deals, unaffordable coverage, and risk so pervasive that even insurers fear to insure. The boom didn't end with rising interest rates. It ended when protection itself became unaffordable. Tampa's real estate market hasn't just cooled, it's suffocating.
Number 5. Houston, Texas. Texas is learning that everything really is bigger here, including insurance bills. After years of record flooding, hurricanes, and billion-dollar hailstorms, premiums across the Houston metro have exploded more than 80% since 2020. A typical 3-bedroom home now costs $5,200 a year to insure, up from $2,800 just 3 years ago. Waterfront or bayou-adjacent homes can easily top $8,000 to $10,000 depending on coverage. The problem runs deeper than storms. Texas's deregulated insurance market gives carriers enormous flexibility to raise rates, and they're taking full advantage. Some have even begun adding exclusions, carving out flood or wind coverage entirely, leaving homeowners paying thousands for policies that don't protect them from the very risks they fear most. Neighborhoods near Buffalo Bayou and Cypress Creek are practically frozen. Lenders reject applications when floodplain premiums exceed affordability ratios, while buyers abandon closings mid-process. Sellers are slashing prices by $50,000 or more, yet listings linger. Developers are pausing projects, waiting for stability that never comes. Even Houston's strong economy and job growth can't offset the pressure. For every new family moving in, another is moving out, unable to stomach the insurance math. Realtors say confidence has collapsed. No buyers no longer ask about schools or commute times. They ask one thing: can I get coverage? Houston may still build big, but its housing future is shrinking fast.
Number 4. New Orleans, Louisiana. Few American cities understand insurance pain like New Orleans. Since Hurricane Ida, insurers have fled the region in droves, leaving homeowners stranded in the state's insurer of last resort, Louisiana Citizens. Premiums there are now 112% higher than private plans were just 5 years ago, turning basic coverage into a luxury item. In some neighborhoods, modest single-family homes face annual bills topping $10,000, and that's before flood insurance is added. For buyers, it's a nightmare. Deals collapse the moment quotes arrive. Agents describe clients who fall in love with a property only to walk away in disbelief when the insurance estimate eclipses their mortgage payment. Lenders are tightening standards, and even cash buyers are pulling back, afraid of endless premium hikes and hurricane risk. Entire communities, from Lakeview to St. Bernard Parish, have turned into fields of for sale signs. Average days on market now exceed 300, and rental investors are retreating because premiums erase every ounce of profit. Homeowners who once saw property as a legacy now see it as a liability. But this crisis isn't just financial, it's emotional. For locals, New Orleans isn't a place, it's an identity. Yet that identity is becoming impossible to afford. Generations who rebuilt after Katrina now face an invisible storm, one made of bureaucracy, insurance spreadsheets, and fear. Longtime residents are watching their family homes slip away to forces they can't control. Rising seas, rising rates, and insurers who've simply given up on the city. In 2025, New Orleans isn't just fighting hurricanes, it's fighting insurance insolvency itself. And unless something changes soon, this city may see its housing legacy washed away, one policy at a time.
Number 3, Miami, Florida. Miami's glittering skyline, once the symbol of limitless wealth, has become the face of fragility. For decades, the city defined luxury, but today it defines risk. Premiums on waterfront condos and ocean view homes have risen more than 300% in just 5 years. A high-rise unit that once cost $2,500 to insure now demands $10,000 or more, while coastal mansions face premiums of $40,000 plus annually. The fallout has been swift and brutal. Wealthy investors, particularly from Latin America and New York, are unloading properties at record speed. Inventory in Miami-Dade is up 92%, and nearly half of all listings show price cuts. Sellers who once dictated terms are now offering concessions, buy-downs, and even furnishings to close a deal. Even cash buyers, once the bedrock of this market, are pulling back, realizing that reselling in an uninsurable environment could be impossible. Banks are refusing loans for condos that fail to meet Florida's new reserve and inspection requirements, leaving thousands of units effectively unsellable. Agents describe deals collapsing weekly. Insurance killed the Miami dream, one realtor told Bloomberg. And she's right, because this crisis isn't about demand, it's about sustainability. The city that once built towers of glass now stands on shaky ground. Rising seas threaten foundations, new legislation adds red tape, and insurers are exiting faster than developers can pivot. Even rental investors are fleeing, citing vanishing profit margins as costs soar. Miami's transformation from luxury capital to liability zone happened quietly, then all at once. The question now isn't how much homes are worth, it's how long they'll stay insurable.
Number 2. San Francisco, California. In San Francisco, the housing market isn't just collapsing under price, it's collapsing under panic. After years of wildfires, earthquakes, and decaying infrastructure, California's insurance crisis has reached the Bay. Premiums for a typical single-family home now range from $6,000 to $12,000 annually, depending on location and proximity to risk zones. In hillside neighborhoods near Marin and the East Bay, quotes are climbing even higher, some exceeding $20,000 for full coverage. Dozens of major carriers have pulled out of the market entirely, while others have imposed new restrictions that make coverage nearly impossible for average homeowners. The state's FAIR plan, originally meant as a stopgap, is now the only option for many, but it excludes theft, liability, and key structural protections. The ripple effects are devastating. Pending home sales are down 40% year over year, and luxury listings in Pacific Heights and Nob Hill are stagnating. Sellers slash prices by hundreds of thousands, and yet buyers still hesitate, fearing uninsurable risk. Even wealthy tech executives, people who once paid in cash without blinking, are now walking away mid-deal when they see insurance quotes. Some lenders are pausing funding entirely unless buyers can prove long-term coverage. San Francisco's once frenzied market feels paralyzed. Real estate agents describe ghost showings, where no one attends open houses and online listings gather clicks but no offers. The irony is bitter. In one of the richest regions on Earth, homes worth millions have become uninsurable assets. For decades, San Francisco symbolized prosperity and progress. Today, it stands as a symbol of fragility. A city where climate, cost, and bureaucracy have conspired to make ownership itself unsustainable. The conversation has shifted from, can you afford to buy, to, can you afford to insure? And increasingly, the answer is no.
Number 1. Fort Myers, Florida. And at number 1, Fort Myers, the ground zero of America's housing insurance crisis. Hurricane Ian didn't just devastate a coastline, it rewrote the rules of real estate. Once one of Florida's most promising coastal markets, Fort Myers has become a textbook example of how a natural disaster can evolve into a financial one. 2 years after the storm, the scars are still visible. Entire neighborhoods from Iona to Cape Coral remain dotted with blue tarps, half-repaired homes, and for sale signs weathered by the sun. But beneath the visible damage lies an invisible disaster: insurance. Premiums for even modest properties now exceed $11,000 a year, while waterfront or larger homes can surpass $18,000, rivaling annual mortgage payments. Hundreds of insurers have abandoned the region, leaving only Citizens Property Insurance and a few surplus line carriers. Their policies come with sky-high deductibles, limited protection, and suffocating premiums. Flood insurance adds thousands more, making ownership unaffordable for average families. Home sales have collapsed by over 60%, and 1 in 3 active listings has sat unsold for more than a year. Investors who once treated Fort Myers as a gold rush are gone, labeling it untradeable real estate. Properties too risky to buy, too costly to keep. The economic shockwaves ripple beyond housing. Construction projects are stalled, small businesses are closing, and families who rebuilt after Ian now face a cruel twist. They can't afford to live in the homes they just restored. Some residents have walked away entirely, leaving behind empty neighborhoods, not from floodwater, but from financial exhaustion. The saddest truth: for thousands, the hurricane didn't destroy their homes, insurance did. Fort Myers has become the clearest warning in America's new housing era. When climate meets cost, ownership collapses. This isn't just Florida's problem anymore. It's a blueprint for the crises still to come. Because if Fort Myers is the future, then no coastal city, not even the wealthiest, is safe.
Across America, insurance has quietly become the new mortgage. And for millions, it's the reason the dream of homeownership is collapsing. From California's wildfires to Florida's hurricanes, risk has finally come home. The question now isn't whether the housing market will recover, it's whether anyone will still be able to afford to insure it. You've been watching Discover the Nation. If you found this breakdown eye-opening, subscribe and stay with us, because next week we're revealing the states where home ownership itself is becoming extinct.